when stability became the illusion Europe trusted most. For decades, Europe believed its banks were finally under control. Balance sheets looked calm. Crises felt distant. Risk seemed engineered away. And that confidence changed everything. To understand why this illusion mattered, we need to rewind. Because the same belief is quietly shaping Europe's banks again today. Stability was not just a goal. It became a promise people stopped questioning. After the devastation of the 20th century, Europe rebuilt its financial system with care. Banks were redesigned to be conservative, regulated, and nationally anchored. Credit flowed slowly. Failure was rare. Trust became the system's foundation. For a long time, this model worked. Then Europe changed. Borders softened. Capital moved faster. Markets grew deeper. Banks expanded beyond their home countries, chasing efficiency and scale. Stability was no longer local. It was supposed to be continental. The logic seemed flawless. If risks were shared across countries, no single shock could break the system. If rules were harmonized, bad behavior could be contained. If supervision was stronger, crises would become relics of the past. And so, confidence grew. Banks held similar assets. Governments trusted the same safeguards. Models agreed with each other. Stress tests confirmed what leaders wanted to hear. Europe was different now, or so it believed. But beneath the surface, something subtle was happening. Uniformity replaced diversity. Coordination replaced caution. When everyone follows the same rules, mistakes stop being isolated. They become synchronized. At first, the synchronization looked like strength. Funding costs fell. Cross-border lending surged. Markets rewarded sameness with lower risk premiums. The system appeared smoother, cleaner, safer than ever before. Yet stability, once assumed, changes behavior. Banks take comfort in safety nets they never expect to test. Regulators grow confident in frameworks designed for yesterday's threats. Governments begin to rely on banks not just as lenders, but as partners. Slowly, the idea of resilience shifts. It stops meaning the ability to fail without collapse. It starts meaning the belief that failure will not happen at all. This is where the story truly begins. Because the most dangerous moment for any financial system is not panic or stress or even crisis. It is the moment stability becomes unquestioned. Once stability is accepted as permanent, priorities quietly change. Banks stop preparing for rupture and start optimizing for efficiency. Capital buffers are trimmed. Liquidity is managed, not hoarded. Risk is no longer feared. It is calculated, packaged, and redistributed. Across Europe, balance sheets began to converge. The same sovereign bonds, the same funding structures, the same assumptions about what could never go wrong. Diversity faded, replaced by standardized confidence. This convergence was encouraged. Regulators wanted comparability. Markets wanted clarity. Rules rewarded assets labeled as safe, predictable, unquestionable. And nothing appeared safer than government debt inside a unified Europe. Banks loaded up, not because they were reckless, but because they were rational. Sovereign bonds required little capital. They offered steady returns, and they carried the implicit promise of collective support. The link between banks and governments tightened. States relied on banks to absorb debt. Banks relied on states to remain solvent. Each believed the other was the anchor of stability. At the same time, funding structures shifted. Wholesale markets replaced traditional deposits. Short-term borrowing funded long-term assets. As long as confidence held, liquidity was abundant and cheap. No one saw danger in this. After all, markets were deep. Counterparties were trusted. Central banks stood ready as backstops. Liquidity, it was believed, could always be accessed when needed. But liquidity is not a resource you own. It is a condition that exists only while others believe in you. The moment trust wavers, it vanishes. Still, warnings were muted. Stress tests assumed orderly markets. Risk models relied on historical calm. Scenarios imagined shocks, but never synchronization. What if every bank needed liquidity at the same time? What if every government faced rising borrowing costs together? What if safety itself became the source of fragility? These questions rarely surfaced. The system appeared self-reinforcing. Confidence fed stability. Stability fed confidence. and Europe moved forward, convinced it had outgrown its past. Yet beneath the calm, dependencies multiplied. Banks became mirrors of each other. States became intertwined through shared guarantees. A problem anywhere now had pathways everywhere. The illusion was not that risk disappeared. It was that risk became invisible. The danger of invisible risk is not its presence. It is the speed at which it reveals itself. When stress finally arrived, it did not announce itself loudly. There was no single collapse, no clear breaking point. Instead, confidence hesitated, and that hesitation was enough. Funding markets tightened first, not because assets were suddenly worthless, but because nobody knew who was exposed to whom. Trust, once assumed, became conditional. Banks reacted as they were designed to. They preserved liquidity. They reduced lending. They pulled back from markets that felt uncertain. Individually rational decisions began to collide. What made this moment different was scale. Because balance sheets had converged. Every bank was adjusting in the same direction, selling the same assets, seeking the same funding, looking for safety in the same places. Prices moved sharply. Sovereign bonds, once unquestioned, came under pressure. Yields rose. Valuations fell. And banks holding those bonds felt the strain immediately. The loop tightened as government borrowing costs increased. The value of banks' safest assets declined. As banks weakened, governments faced rising support expectations. Each side destabilized the other without intending to. This was not a failure of discipline. It was a failure of design. A system built on shared stability struggled with shared doubt. Liquidity support arrived, but cautiously. Central banks stepped in to calm markets. Emergency facilities expanded, but intervention itself carried a message. Something was wrong. That message traveled fast. Investors repriced risk across board. The danger of invisible risk is not its presence. It is the speed at which it reveals itself. When stress finally arrived, it did not announce itself loudly. There was no single collapse, no clear breaking point. Instead, confidence hesitated, and that hesitation was enough. Funding markets tightened first, not because assets were suddenly worthless, but because nobody knew who was exposed to whom. Trust, once assumed, became conditional. Banks reacted as they were designed to. They preserved liquidity. They reduced lending. They pulled back from markets that felt uncertain. Individually rational decisions began to collide. What made this moment different was scale. Because balance sheets had converged. Every bank was adjusting in the same direction, selling the same assets, seeking the same funding, looking for safety in the same places. Prices moved sharply. Sovereign bonds, once unquestioned, came under pressure. Yields rose. Valuations fell. And banks holding those bonds felt the strain immediately. The loop tightened as government borrowing costs increased. The value of banks' safest assets declined. As banks weakened, governments faced rising support expectations. Each side destabilized the other without intending to. This was not a failure of discipline. It was a failure of design. A system built on shared stability struggled with shared doubt. Liquidity support arrived, but cautiously. Central banks stepped in to calm markets. Emergency facilities expanded, but intervention itself carried a message. Something was wrong. That message traveled fast. Investors repriced risk across borders. National distinctions faded. What mattered was exposure to the system as a whole. The very integration that promised protection now transmitted stress with remarkable efficiency. Fragmentation appeared where unity was expected. Capital retreated behind borders. Trust narrowed to the familiar. Regulators scrambled to respond. Rules designed for isolated shocks met a continental event. Flexibility replaced certainty. Exceptions multiplied. In trying to preserve stability, authorities bent the very frameworks meant to ensure it. And with every adjustment, the illusion weakened. Because the system was no longer proving its resilience. It was revealing how much it relied on belief. The real shock was not collapse. It was how quickly certainty dissolved. Markets did not panic at first. They paused. And in modern finance, hesitation is often enough to break momentum. Funding became selective. Prices became fragile. Trust stopped being automatic. Banks responded defensively. They shortened lending horizons. They hoarded liquidity. They reduced exposure wherever uncertainty appeared. Each decision made sense on its own, but systems do not experience events individually. They experience them collectively. And Europe's banks had grown almost indistinguishable. The same assets, the same assumptions, the same escape routes. When pressure increased, they all moved together, selling similar holdings, seeking the same funding sources, pulling back from the same counterparties. What had once been diversification now behaved like duplication. Government bonds, long treated as anchors, became stress transmitters. As yields rose, balance sheets weakened. As balance sheets weakened, confidence in state support faltered. The relationship that once promised stability began to amplify doubt. This feedback loop tightened quietly. No alarms, no dramatic failures, just incremental pressure building across borders. A system straining without a clear breaking sound. Liquidity facilities expanded. Central banks reassured markets. Extraordinary measures were framed as temporary, but each intervention confirmed an uncomfortable truth. Stability now depended on constant reinforcement. Investors noticed. Risk was reassessed not by country, but by structure. Exposure mattered more than location. Integration erased the comfort of distance. Capital retreated toward perceived safety. Cross-border flows slowed. Financial fragmentation returned, even without formal barriers. The single market began to behave like many cautious ones. Regulators adapted in real time. Rules softened, deadlines shifted. Consistency gave way to discretion. Frameworks designed to prevent crises were adjusted to manage one already unfolding. With every adjustment, confidence relied less on rules, and more on judgment, less on predictability, and more on belief. And belief, once questioned, never fully returns unchanged. The climax did not arrive as a single moment. It unfolded as a realization. Europe's banking system was not collapsing. It was being sustained, continuously, deliberately, carefully. What once functioned through structure now depended on intervention. Stability no longer emerged naturally from design. It had to be maintained again and again. Emergency tools became familiar. Liquidity lines stayed open longer. Guarantees expanded quietly. Temporary measures stretched into policy fixtures. None of this was reckless. It was necessary. But necessity carries consequences. Because when a system survives every shock, it stops learning how to absorb them. Failure is postponed, not processed. Risk is shifted forward, not removed. Banks adapted. They optimized for regulatory survival. They planned around central support. They treated intervention as part of the environment, not an exception. Governments adapted too. They relied on banks to transmit policy. They leaned on financial systems to stabilize economies. The line between market and state blurred further. What emerged was not fragility, but dependence, a system that works only as long as confidence is continuously supplied, only as long as coordination holds, only as long as belief is renewed. This is a real legacy of the illusion, not that Europe misunderstood risk, but that it misunderstood resilience. Resilience is not calm. It is the ability to fracture without failing, to allow stress without collapse, to let parts break so the whole can endure. Today, Europe's banks are stronger by many measures. More capital, more oversight, more coordination. But they are also more synchronized than ever, which raises a quiet question. If the next shock arrives differently, will the system bend, or will it once again rely on belief to hold? Subscribe to join the journey. When